Oil prices have been tumbling lately, so what's the relationship between oil and the stock market? When energy prices are low, you'd expect that to be a good thing for the economy and the stock market. Sure, oil stocks will get crushed. Many of the big ones like Exxon, Chevron, and BP already have. But consumers will spend more, and companies will save on energy costs. That will boost profits and stock prices. History shows that low oil prices are common during bull markets. That was the case in the second half of the 1980s, when oil prices were below $20 for 5 years and the S&P 500 pretty much doubled. And it happened again in the late 1990s during that irrational market exuberance. But low oil prices aren't always a good thing. If they fall too far too fast, that could be a troublesome sign, and that's why some investors are spooked today. Just look what happened in 2008 and 2009. As the financial crisis caused a global recession, the price of oil plummeted along with demand, and so did stocks. Nobody was celebrating cheap gas prices back then. They were too worried trying to hold on to their job and agonizing about all the money they lost in their 401ks. So is the current drop in oil like the 80s and 90s, or something to be more worried about like 2008? It's too soon to tell. Some would argue that the plunge in oil prices are more about a supply glut than demand concerns. The U.S. is producing more oil after all. If that's what's causing cheap oil, stocks may shrug off the oil market's woes. So what's the relationship between oil and stocks? If they were friends on Facebook, they might say it's complicated.